Chapter 13, Sources of Financing. Here we have a little bit of a breakdown of where mortgages go. So we have residential, which is about 75% of mortgages. We have multifamily, which is a much smaller percentage. We have commercial, which is about 18%. And then we have farm at 1%. I thought farm would be at least a little bit more than that, but apparently not. Here we have traditional versus modern housing finance. So if you look at the bottom left of this slide, this is what lending used to look like before about the mid-1970s. If you wanted to get a loan, you would go to your local bank and you would talk to the banker that you went to high school with, and he would give you a loan and you would pay that bank every single month. So that is the traditional way. Now, however, we have the secondary mortgage market, and because of that, even if you get a mortgage with a local bank, they immediately are going to sell it, and they are going to sell it to the capital market. They're going to securitize a lot of those mortgages. They're going to pool them together, create securities for people to invest. And it's just an increasing number of ways for investors to make money through the secondary market. So the secondary market isn't even just national. This is a global thing. So traditionally, you would get a loan at a small bank, it would stay there. Now, however, and this started, like I said, about mid-1970s, the secondary market began, and we were able to really start to use mortgages as ways to invest money. This is a super old slide, okay, but this is where I'm showing you that around the mid-1970s, you saw the secondary mortgage market really start to make a difference. So if you look at the color, it kind of looks like that Pepto-Bismol color. This is the color that we're looking at to see the increase in mortgage securitization. Mortgages were pooled together to create security so that people could invest. And so as you can see, this only goes up to 2008, but you can see that a huge percentage of mortgages are securitized. And it's even more than that today. Let's talk a little bit more about the primary market versus the secondary mortgage market. So the primary mortgage market is where lenders originate loans. This is where the borrower and the lender are getting together. This is where they meet. So we have different people that are a part of the primary market. We have savings and loan associations, credit unions, mortgage bankers, mortgage brokers, commercial banks. And we're going to talk about most of those different types. And then we have the secondary mortgage market. This is the market where existing home loans are resold. So it's like a wholesale market. Now, there's several different players in the secondary market. You have government-sponsored enterprises like Fannie Mae and Freddie Mac. We have wholesale mortgage bankers, and there's also loan securitizers. In the primary market, the source of funding is divided into two different categories, really. We have markets that are regulated by the federal government. So these would be commercial banks, savings and loan associations, savings banks. And then we have markets that are not regulated by the federal government. So when you watched House of Cards, that would be this section, right? Not regulated by the federal government. So we have commercial finance banks, investment bankers, life insurance companies, finance companies. All of these are examples of the types of companies that, quite frankly, were the problem and the reason for the housing crash, or at least one of the reasons. Here we have some primary loan sources. We have savings and loan associations, commercial banks, life insurance companies, mortgage brokers, municipal bonds, computerized loan origination. So there's lots of different loan sources. And we're going to take some of these and break them down individually and talk a little bit more about them. Savings and loan associations. Every single time I get to this slide, every single semester, it always makes me think about that movie that always comes on at Thanksgiving and Christmas. It's called It's a Wonderful Life. If you haven't seen it, you need to watch it. Okay, it's a great movie. But in the movie, George Bailey owned the good old savings and loan. And this always makes me think about that whenever I see this slide. Now, the savings and loan associations were formerly the backbone of mortgage finance. This is how mortgage finance actually started. They dominated the mortgage lending industry for years. But because they were so local, Okay, they were extremely localized. That was really their downfall. The fatal flaw is they were funding long-term loans with short-term savings, and that's only going to work for so long, right? And then once you started seeing these big commercial banks come into play, these savings and loan associations were just too small to compete with them. So most former savings and loan associations are now banks that have like boutique roles. So they have specific things that they do. So commercial banks historically met all of the real estate needs of business clients. They would do business-related real estate loans. They did do some home loans, but it was more business-related than anything else. Commercial banks these days do everything, okay? Large-scale construction lending, any kind of home loan, any kind of business loan, any type of mortgage. The commercial banks will do it all. But originally they started out as meeting the needs of business clients. So here I want to differentiate between a mortgage banker and a mortgage broker. So the first term is a mortgage banker. Now keep in mind, if you are a mortgage banker, this is not a bank, okay? You do not work for a bank. They do not accept deposits. However, they do originate loans to sell. They also retain the right to service the loan for a fee. So let me give you an example. There is a mortgage company in Statesboro called Ag South. They're actually all over the Southeast. The very first house that I bought, I had it financed through Ag South Mortgages. And not only did they originate the loan for me, but they actually retained the right to service the loan. So for literally like 7 or 8 years, I paid my payment every month to Ag South Mortgages. Okay. Now, typically that doesn't happen. If you were to go to, say, Synovus and get a mortgage loan, they're probably going to immediately sell it to someone else. They have all of these investors who are buying these mortgages immediately. But mortgage bankers, on the other hand, they're not really a bank. They don't accept deposits. So you can't go to Ag South Mortgages and open a checking account. That's not the way it works. They originate loans to sell. So they do farm loans, which is where the ag comes in, but they also do home loans. They originate the loans. They also can retain them for a fee. They can sell them if they want to, but a lot of times they will retain it. And then we have mortgage brokers. Mortgage brokers bring the borrower and the lender together, and the broker receives a fee for that. They never own the loan. Okay? Basically, these are companies that specialize in the detail of the origination of the loan. So let's talk a little bit more about these mortgage brokers. When you watch the House of Cards documentary, all of those mortgage brokers that they were talking about that were getting paid a lot of money, this is what they were referring to. Okay? So mortgage brokers place the borrower's loan application with the lender. They receive an application fee. They receive a part of the lender's origination fee. They never own the loan, and they never service the loan. Basically what they're doing is they're just finding a borrower, and they're connecting that borrower with the lender who's going to give them the money. So they're like the go-between. Now, in the early 2000s, this was a rapidly growing aspect of the industry. Mortgage brokers everywhere. And the reason why is because there were no qualifications. You didn't have to have a license, nothing. I mean, anyone could be a mortgage broker. All you got to do is find someone who wants a loan, put it together with the lender. They had very few repeat customers. They were always paid on the front end, which means that you're not worried about repeat customers. And very low competency requirements. Like I said, there was no licensing required. Huge problem. Just like most things, hindsight is 20/20. This clearly should have been an issue to begin with, but people were making money. So what were they doing? They were doing it anyway. Now let's talk about the beginnings of the secondary mortgage market. We have Ginnie Mae, which was created in 1968. They are empowered to guarantee pass-through mortgage-backed securities based on FHA and VA loans. We also have Fannie Mae, which was also begun in 1968, and they were primarily the purchaser of FHA and VA mortgage loans. We then have Freddie Mac, which was created in 1970, and it was formed to purchase and securitize conventional home loans. And then we have Farmer Mac, which was created in 1987, and it was formed to establish the secondary market for farm real estate loans. Okay. Ginnie Mae stands for Government National Mortgage Association. and it is a government-owned and financed organization, and they create the major pass-through mortgage-backed security programs. They do not buy mortgages. They don't buy any mortgages at all. However, they guarantee mortgages that they look at that they actually securitize. They only guarantee securities that are based on FHA and VA loans. Okay? So I'm going to show you an example in just a second of what it is that they actually do. In the House of Cards documentary, they talked about mortgage-backed securities. Mortgage-backed securities are where you take multiple mortgage loans and you pool them together to securitize them for people to invest in. The security, when you're taking little bits of mortgages and you're pooling them together, they create a security that entitles an investor to a share of all the cash flows that come from that security. So whenever we're creating a mortgage-backed security, we're looking for loans that are similar to one another. So if you have a pool of loans, you want all of these loans to be similar. So if you're doing a pool with FHA mortgages, they're all going to be FHA. If you're doing a pool with VA loans, they're all going to be VA. You also want loans that are the same vintage. So if they were created in 2008, you want all of them to be created in 2008. You're also looking for similar interest rates with regards to the loans. Now, nearly 2/3 of all new home loans have been securitized in recent years, and I showed you that at the very, very beginning of this presentation. And so if all of these loans are being securitized, don't we need to guarantee at least some of them? Okay. That's what Ginnie Mae does. So here's how this works. This is the Ginnie Mae mortgage-backed security process. So we have this mortgage banker up here at the top, and he has all of these different houses that he wants to securitize. He wants to pool them together, and he wants to guarantee that whoever is investing in this is going to get a specific rate. So he has all of these mortgages that are at a 7.5% rate. He pools them together, and he's going to sell them to an investor who is guaranteed at least 7%. So you can see how the banker is making a little bit of money off the top there. Ginnie Mae is going to look at all of these mortgages as they are pooled together, and they're going to guarantee that, yes, if you invest in this, you're going to get 7%. Okay? And that's basically how it works. It provides you with a guarantee. Remember how I told you Ginnie Mae was created in 1968? And at the very beginning of the presentation, I talked about how securitization really didn't start until about the mid-70s. And as you can see here, they start in 1980, and you're seeing about a little over 10% of securitization that is happening. By 2008, we have about 65%, not quite. We're way over 70% at this point. So the mortgage securitization process has significantly grown over the last, how many years is that now? Over the last 40 years. So Fannie Mae is a part of the secondary mortgage market. Originally, it was a secondary market for FHA and VA loans. Now, Fannie Mae does not lend money to home buyers. They do, however, ensure that mortgage funds are consistently available and affordable because they buy mortgages from qualified lenders. Okay? They have securitized and sold, or they own about 23% of outstanding home loans. Now, when the housing market crashed, they were actually taken into conservatorship by the U.S. government in 2008. Freddie Mac is very similar to Fannie Mae, but they were dealing specifically with conventional loans to start out with. They also put a greater emphasis on mortgage-backed securities. Now, they were also, just like Fannie Mae, taken into conservatorship by the U.S. government in 2008. Now, some people say that Fannie and Freddie caused the housing crisis by investing in poor quality loans. Others argue that Fannie and Freddie were the only prudent investors active in the secondary market. So you make the call. What do you think? Farmer Mac deals primarily with farm loans. It was established through the Agricultural Credit Act of 1987, and they underwrite loan pools for farms. In 1996, Congress passed the Farm Credit System Reform Act, which actually allows Farmer Mac to act as a pooler for qualified loans. So now they're permitted to purchase loans directly from originators, and they can issue their own 100% guaranteed securities that are actually backed by those loans. So here we're looking at how the primary market and the secondary market interact with one another. You have mortgage lenders who are loaning money to borrowers. Where are they getting that money from? They're getting it from the secondary market, from financial intermediaries, and then the borrowers are getting the loans through the mortgage lenders. They're selling these loans to investors, and it all just goes around in a big circle. Here we're looking at an example of how the traditional system works and then how the secondary market system actually operates. So what are usury laws? Usury laws are found in nearly all states, and it is a state legislation that imposes an interest rate ceiling on loans. Now here's the thing. Low interest rates and the availability of funds have made loans so competitive lately that usury really isn't much of an issue anymore. If we get to a point where interest rates start to climb significantly, then you're going to see this as more of an issue. We have a couple of terms here just to finish out this chapter. The first one is the due on sale or call clause. Now you've actually heard this before. This is also referred to as the alienation clause. This requires immediate payment of a loan balance if ownership transfers to someone else. So we have talked about this before. If you sell a property, you have to pay whatever existing balance you owe on your current mortgage. We also have a prepayment penalty. This is a penalty for the right to repay a loan early. So let's say that you finance a house for 30 years. And within the first 6 months, you get a job in another state and you have to sell it. So it could be that you have a prepayment penalty on your mortgage where if you sell it within the first 2 years of being in that mortgage, there is a penalty for the sale. So usually it's a percentage of the loan amount. You don't typically see this though with residential mortgages. Usually you're going to see this more with commercial loans because commercial loans are for a much larger amount most of the time, and the lender they're basically saying, hey, I want to get at least a certain amount of profit from this loan, and so they'll tack on a prepayment penalty if you pay it early.